document splitting, classify GL accounts for document splitting, AA42 chart of accounts, or control Y. 80220, control Y. Okay. Now we go back, classify GL accounts, T68A, new entries, and we will copy. Okay. What is document splitting? I'll explain later. Vendor special GM. Okay, save. Okay. Okay. Now this is done. Zero balance clearing accounts. 8842. Let's see. 80250. Okay. New entries. 80250. Okay. 80250. This is done. Eight- 80250. Go. Specify level, check organizational structures. Extended define document splitting method. Question. Okay. Now, what is document splitting? Let's come to this discussion. Okay. Doc splitting. What is doc splitting? For example, you buy some material or stationery or purchases from vendor. You pay input tax, okay, which is sales tax. Okay. And you also pay withholding tax also. You withhold tax from the vendor. Okay. But these purchases, for example, are of $12,000. Out of this $12,000, Profit Center C001 used $3,000 of material, stationery, whatever. Okay. N001 used, let's say, $5,000 of material, okay, and stationery. And S001 used 4,000, let's say how much? Yeah, 4,000 of station. But in simple financial entry, you cannot track, you cannot track the profit center usage, the consumption. So what happens is that when document splitting is done, and what it does, it doesn't create entries like this. It creates entries like this. Material, debit, 3,000, vendor, credit, 3,000, and sales tax, for example, will be your debit, 100. Withholding tax will be, um, let's say, $20. Okay. So this is for profit center C001. So it is, of course, it is buying for $12,000, but it will also assign to that profit center. Okay. And that is why we actually create document splitting. If we look at how we do it, classify GL accounts. Over here, if we look at it, all revenue accounts, for example, will be governed and supervised by category 30,000. Okay. And vendor will be governed, vendor series will be governed by 3,000, which is for category. Then we have page down taxes on sales and purchases. It will actually split taxes for profit centers. It will split withholding tax. Okay. So, document splitting helps in tracking profit center consumption. Okay. And what is zero balance clearing? Let me tell you that also. Zero balance is nothing but zero balance account is what, let's say, C001 profit center accumulated withholding tax for of 230 for the month 233.08 and 001 accumulated withholding tax of, let's say, 115.047 and S001 accumulated let's say for 300.11. Now it will actually assign, or let's say the total withholding tax was addition of all sum of all this. Let's say the sum is like 500.62. Okay, it will distribute 500 to all the profit centers, but 62 is not distributable. So what it will do, it will collect 0.62, and in the next one it will collect 0.44. In the next month it will collect 0.27, and it will add all these and make it a round figure and then distribute to the profit centers, so that by the end of the accounting cycle, there will be zero balance. So that is basically because your taxes are never round figures, they are in decimals, right? So that is the rule of zero balance account. So that's why we assigned a zero balance account, T68A, and this is our zero balance account. Okay. So now we can move forward and let's go to master data, profit center, and of assignment objects to profit centers, and assign default profit center to accounts. double A 42. Now over here we have some accounts that we have made, and we have assigned default profit centers for document splitting as well. This helps whenever this account is hit with an entry, it will automatically default this profit center. Okay. So in the next step, what we'll do /O fs 00. Okay. Now we are over here, and 101, 101 of AA 42, we will copy it to T68A, save, save. Okay. Now we are creating documents. 2000, 20,000, retained earnings account, T68A, continue. Now we are making GL accounts. This is the front end activity of GL accounts. Okay, GL account is made. 30201, save, hmm, save. Field status is not defined if field status variant 02 contains error. You cannot save. Okay. G01, general. We'll discuss this later, but let's first create all the accounts. 60,000 recon accounts. Recon accounts. 60200. Double click. Continue. Save. 80250. Zero balance clearing. 80300. Input sales tax. 80330. Okay, this is done. Save. Now we can create entries, the same entries. Copy, Control Y, Control C. Assign default profit center to accounts T68A. New entries. Enter. Save. Save. Okay, because we have already created these accounts and these profit centers are already made. Okay. So in profit centers, we can assign fixed assets, production orders, production planning orders, process orders. We can assign to profit centers. Okay, so this is how powerful profit centers are. Now, what we'll do next is /n FB01L. Let's create an entry. 40 is posting key. What is posting key? I'll tell you later. 3030201. Number range is missing. Okay. Continue. Continue. Copy to company code. Fiscal year 2024, AA42 will copy from this to T6800, T68A. Execute. Yes. Interval is added. Now it will give more errors, but we'll see. Okay. 30, let's say 2000 expense to cash. 50 10101. No tolerance is entered. Define tolerance groups. Now, what are tolerance? I'll tell you that. Define tolerance. New entries T68, T68A. Amount per document that employees can enter maximum amount, and maximum open amount that they can clear against a vendor or customer is this much. Maximum amount per document that they can enter. So you can control irregularities, financial irregularities. This is a control basically. Save, save. Okay, enter, enter. Okay, we'll have to slash n FB01L 3020 30201 2050 1001. Profit center 30201 requires to profit center. Why profit center? This is expense. Okay, let's enter any C001. Oh, I understand. OB04. CRO. View status variants 01. View status groups. Four copies. G02. G01. Assignments. Oh, okay. Cost center is this. No. Assign company code to field status variants T68A. We'll use 8842. Save, save. FB01L. Header text 2000 expense to cash 20201, 2000, 101. Oh, oh, let's do it in the next one.